All right, so today we're going to be talking about permanent life insurance. So, 2 weeks ago, Ryan covered the training on term life insurance and a quick recap of what term life insurance is. There's two words that I utilize to describe each of them in very layman's terms. Term is if something happens during a set time frame. For instance, I have a 30-year term policy. So if I pass away in that 30-year time frame, that policy will pay out. So because it's for a set period of time, it's going to be lower cost. But we also know the parameters of it's going to be from here to here. Kind of simple, right? Makes sense. We talked about living benefits. We talked about the variety of companies we can work with. We talked about the tools through WealthWave. A number of those things all really apply on the term side. Not all of them apply to permanent life insurance because it's a little bit different. So what I wanted to talk about here today, I had run yesterday an illustration for two different types of permanent life insurance. I don't want to dive into that here. It might be kind of a secondary conversation depending on how much we cover. But Ryan and I will kind of bounce back and forth about the topic here today. So permanent life insurance, going back, term is if, permanent life insurance is when. So in what cases do we use term versus permanent? Ultimately, there's some very specific reasons, but I think more than anything, I've had people in my career tell me, I've watched YouTube videos, I did my own research, I will never buy term life insurance. Why is that? We walk through, hey, we can do permanent, that's okay. And I've had people say, hey, I think permanent life insurance is a scam, I only want term. So having the ability to do both is really valuable. So some reasons why we might want to do permanent life insurance, for one, people will say, well, hey, I know I'm going to pass away someday, so I want to make sure I have something on the books at any stage of my life. I have the cash flow to do it. I understand it's going to be a little more costly because there's a guarantee that this death benefit will pay out. So there's a little more premium associated with it. But part of that then becomes now a couple new terms would be cash value. So maybe we pay $200 a month, but maybe $150 of that goes into your what's called cash value. We'll talk about that kind of later on. That's kind of like an extra savings account for a client. It's their money. And then that cash value can grow and accumulate interest over time. But then there's fundamental then financial planning reasons of why we would want to use permanent life insurance. So before we get started, I actually want to see for the newer people, is there any questions or are there any like things you've maybe heard throughout the years of, pro or anti permanent life insurance at all? You're allowed, Tony, you're allowed to mute yourself at any time. You have permission. We're on summer break.
Got a question, teacher.
Um,
All right, can you hear me now?
mhm.
Yeah, the biggest thing for me coming into the industry as a new guy, um, term life is very simple, very straightforward, and there's always been a pretty prevalent philosophy of BTID, buy term and then invest the difference. And the
Mhm.
idea is that by the time the term is up, you've built enough where you don't need it, or it's not like you call it like self-insured. Um, I learned that I mean, probably 20 years ago or so. And my first policy, I had that in mind when I bought it, did not invest the difference is how my life went. And I know I talked to, anybody I've ever talked to that has it, they don't tend to do that. Like it seems to be something that looks good on paper, but doesn't really happen. And so I was very
Yeah.
intrigued learning about permanent life and at that conference in Columbus, the Altitude Conference. There were some good presentations on using permanent life as a tool. I have since read a few things about it being kind of like looked at as almost like a tax-free vault, like when these benefits pass down, they're not pilfered by taxes for the beneficiaries, and a lot of rich people use these as an instrument. So I'm very eager to learn more about it because, term, like I said, very simple, easy to understand. But the permanent life, it was kind of interesting to me how creative these products can get.
Yeah, absolutely. So I think you bring a good point. I think a lot of people that we will talk to have heard or understand or believe in what you said of buy term and invest the difference. And I think you painted a great picture. Anything that we can like really say, there's all these types of like, go-to strategies of like how to, live on a certain income threshold of your budget or, whatever you want to say. Anything will work as long as it works. So buy a term and invest the difference works if you then invest the difference. But also, it's a very cookie cutter thought process. So all six of us have totally different place. We're in different places of life, different amount of kids, different stage of life, different income thresholds, savings goals. So I think when we say, oh, just buy term and invest the difference, well, that's not necessarily always applicable to everyone's kind of financial background or what their goals are. So yeah, it's a valuable thing to think about. Becky, were you going to say something as well? Nope, don't want to be put on the spot. So no, I think really that's the big thing is people come in, hey, I've heard of whole life before. I don't want whole life. But that's one type. Joe, you just unmuted yourself.
Yeah, what do you say to the person that comes in and says, "Oh, you know what? I have life insurance through work. I'm good."
Okay. Well, I think that goes back to the training 2 weeks ago is how much do you have? What do you think is enough? If you do this long enough, you'll quickly have a meeting where you ask the question, how much do you think is enough? And one spouse says 100 grand, one spouse says 2 million, and all of a sudden it's getting a little awkward. So, yeah, what's enough? What type of coverage are you even going to stay at that job long term? No one's ever chosen a job for their benefits package because of how much life insurance was in there. So that's never been the deciding factor. So if someone changes jobs, they are not thinking about how much life insurance they get. So um, yeah, so I have a couple thoughts, but Ryan, do you want to chime in at all here?
Sure. I think appropriateness is the name of the game, whether we're talking about term or permanent. I mean, so much of this is just understanding your client's position before spouting off any, you know, whether it's our position, whether it's rooted in fact or not. I think we need to understand where the client's knowledge level is on this topic, through just question asking. I mean, just to use Joe's example, I hear that all the time. And I say, that's awesome. Do you think your client or do you think your employer has your best interest in mind when it has come to the design of that insurance policy? And just, really pause and really make them think through it and answer on that question. Do you plan to retire with this employer? Right? Pause and make sure that they answer that question and really give the client space to talk. And you'll start to gain hot buttons on where they're at on the spectrum of do they want temporary coverage? Do they want permanent coverage? And then that allows you to kind of peel back the layers of their financial health and well-being. And that was kind of the one thing that I would chime in on is you know, so specifically related to permanent insurance, I own it, I've sold it, I've, had clients push back on it. I'd like to say I'm pretty experienced in, procuring it and, just having my own policies in place. And I've also had policies, get charged back or last 1 year or a couple years. And so what I've learned through all those experiences is that the client has to have a great track record of financial stability in their household. It's a lot like buying a house, and I liken it to that a lot. To sign up for a mortgage is a big financial commitment, and so is permanent life insurance. And so there's just some certain things, between budget, having savings. I want to basically see a litmus test before I, ever present a permanent plan, through all my suitability questions, to determine if this client is going to be a good candidate. Um, and so, that's kind of been my perspective of making sure that it's the right fit, that they can afford it. Um, and if you guys are anything like me right now with your prospecting, you're realizing, people's budgets are tighter. It might be harder to get somebody to commit to $300 a month, for a permanent policy. So we need to be mindful, of where people's budgets are at, where their debt's at, where their true needs are before we get to a strategy like permanent insurance. It's got great benefits for sure. But just the appropriateness is really, really key to understand. And so that's Alec and I's and Tyson and all the veterans that have been doing this. That's our job, is to make sure that the newer people understand, you don't want to walk into a situation and be, hair on fire for a strategy, and then it goes south on you in 6 months. So yeah, we really just have to feel the prospect out, understand where they're at, and that's just the best interest standard of our profession, knowing where clients are at. So yeah, I've got a couple, tips and tricks, that I can share more about, but it's really just their budget, their savings. I need to see a solid emergency fund in place if I'm ever going to bring up permanent insurance. That's a big one for me. Because if they don't have a track record of savings, and I'm looking at a $500 a month VUL, like, that would just be silly to sign a client up for. So, so yeah, and they have to have some sort of permanent need, in my opinion. To Tony's point, I think you're spot on. Like, there's a lot of good things on, in theory, about the buy term and invest the difference, but you're right in your observation that it's very few people actually carry out the second part of that. And so permanent kind of does that for a client. It kind of forces you to save it. And I like that aspect. But they need to be obviously in alignment with the trade-offs. It's not like any financial instrument. It's not the end all be all. It's just one aspect. If you get in and listen to podcasts or YouTube, certain people in the industry who talk on this stuff, the good ones say it's not the end all be all to financial strategies. It's just one aspect, and it should be blended in by a fully licensed advisor that understands the rest of somebody's financial situation and portfolio and risk tolerance. And so it needs to be built in and incorporated correctly. So that's just, yeah, kind of some general remarks about the appropriateness.
Yeah, so we'll take a step back here. So as you guys are, Becky, you're going to be studying for the license right now. Tony already has the license, but when we're talking about permanent life insurance, there's varieties of different types. They really would fall into probably two really major categories. So the first would be called whole life insurance, and then the other one would be called universal life. From there, then there's a couple different types of universal life policies. So as you're studying through some of these things, so whole life, we really as a company do not deal anything with whole life at all. Whole life typically is very fixed costs. You're buying, very small policies. It's kind of pretty expensive. The cash value that's earned or accrued in there really only has to deal with the money that you are paying into it. So we could dive farther into this, but historically, a whole life policy says it's going to earn a fixed return of, call it, 3%. Well, typically what's happening is you're getting what's called a return of premium. So maybe you put in $100 a month, but really you only needed to put in like 80. And so some of what you're earning inside the policy is really just you getting your money back. Not that it's going into cash value, but that you're just kind of getting it back. Um, the kind of the con to whole life insurance is typically there's not a whole lot of cash value built up, and so you're paying on this policy for a very long time, and you never really kind of get ahead. So there's not really the ability to kind of get 6 months ahead or put a really large chunk in and then sit on it. You kind of have to make that, $100 a month premium payment kind of indefinitely. So I have many clients where we have like the universal life where we're putting in a lot right now, but it's so that we don't have to put a lot in or any at all later on in life. So then when it comes to universal life, the big thing and reason why people do universal life is the what's called flexible premium. So flexible premium means that you're not required to make that payment every single month. So I have clients, hey, I just changed jobs or I lost a job or hey, a couple things came up for a few months. Can we maybe lower the premium or can we completely reduce it for 3 months? Whatever might happen in life, we have the flexibility to do that. Where whole life, you miss like one or two payments and that policy's gone, really, no matter what's in the policy. So the flexible premium is really helpful for people to say, hey, you know what, I've got a high cash flow situation now, but maybe in 3 years I won't, or I'm going to take a pay raise in 6 months, so I want to be able to do something today and then increase this later on. We have that flexibility. From there, then, a universal life policy, there's going to be two ways that you can ultimately kind of grow the cash value in there. So the first and kind of pretty common one that you'll hear is indexed universal life. So an indexed universal life insurance policy, you only need your life insurance license to be able to market and sell this product to people. So for those of you that are getting started and then don't yet have your investment licenses, this is a great opportunity to get someone in. If you don't have that license yet, you're not doing anything inherently wrong by the client. I think there's more growth potential, but we can show a side by side of an index universal life and then a variable universal life. There are some advantages, but you're not doing inherently anything wrong to the client. So an index universal life only need a life insurance license. So you've got the flexible premium, but how it then accrues interest is it just tracks a market index. So you put in $100 a month in, maybe you're only required to put in 30. So the extra 70 left over is now going into your cash value. That $70 is kind of sitting in a side kind of a side pocket, a side account for the company, the insurance company, and you're tracking a market index. So we'll call it the S&P 500. So you make a contribution July 1st of 2026. We have $70 sitting over here. So then that $70 is now tracking that market index from July 1st, 2026 to July 1st, 2027. What does the market do during that time frame? And then you will then get interest credited to your policy during that time. This is very confusing. There's a lot to follow here. When I show some visuals next week, it'll make a lot more sense. But we're broadly tracking a market index. So there's not a whole lot of changes until we get a couple years in where we have the ability where on a month by month basis, we're getting credit earning over periods of time. So then the other side of universal life is variable universal life. So think of your 401k, your Roth IRA, all the things that we're investing into the equity world, the stocks, earning interest on a day-to-day basis in the market. Variable universal life, same example, we put $100 in, $70 goes towards the cash value. Well, now we're investing into equity funds. So think of like in a Roth account, we can pick all these different types of funds to invest into. We're going to be able to purchase those things and manage the cash value like we would an investment account. So in this case, you would need to have your investment licenses to be able to market this product to folks. Pros and cons to each. I would argue until you have your investment license, we're perfectly fine doing the indexed universal life. Both are going to be far superior than the whole life strategy. But ultimately, I think long term we'll be able to do a lot more for clients doing variable universal life. So I want to pause here. Any questions about anything that we had just walked through at this point? Going once, going twice? No. Okay. So moving forward, so how do we identify someone even wants this? They need it. Should we even recommend it at all? So, like Ryan was saying, I think when we're sitting down with folks, we don't necessarily know, and not everyone's meant to buy life insurance, and there's not a one size fits all strategy for every single person. So, I think we can only really find out by asking questions. So, the fact finder that we use for folks when we're sitting down with people we have in there talking about life insurance. And it is not meant and designed to be something that we're trying to sell. So when we're getting to life insurance, do you have any? Do you feel like you have enough? Do you feel like you want more? I've gotten a number of policies on the books here, not because I was ready to recommend something, but I simply asked, do you feel like you maybe should have more? And many people that I thought maybe had enough or wouldn't even be interested, they said, honestly, yeah, like I would like to have some more life insurance. Okay, I'm ready to talk to you about it. So from there, then, do they have good cash flow? Is there a need for it? You know, and there's a couple of scenarios where we specifically use it. But when we get to the finish line, I think what we've fallen into a trap on as a team here recently, or maybe I'll just speak to myself, is it's very easy to market the affordability, the simplicity of term life insurance. You know, let's just say maybe it's $1 million. $1 million we can get for 30 years for, you know, $70 or something. I don't know. I'm making these numbers up. It's really easy to market that. Someone understands it. I pay it set period of time. When it's gone, it's gone. But I think what we should be spending more time on is kind of blending policies together. So if someone's maybe need is $1 million, what does it look like to get maybe 750,000 of term life insurance and 250,000 of permanent? Why is that valuable? Well, in just 10 years, I have had clients that started with me 10 years ago or 8 years ago, 7 years ago, and they say, hey, I'm 7 to 8 years into a term policy. And I already know once I get to the end of the 30 years, I'm going to have more life on the other end of that I want life insurance coverage on. So having something permanent, I think allows for that to grow steadily over time, that we might be able to blend those two things together to say we don't need to go and buy a brand new policy 10 years later to rehash a 30-year time frame. We can blend those two things together. But what we ultimately need to do is know where the client's at, but then from there, spending time with clients and understanding and educating them how this fits into an overall plan, how this benefits them, I think is the art and the science of what we do here. So I'll pause there, Ryan. Were you wanting to chime in?
Yeah, I think that well stated on the blended approach. That is, I think, can be a great happy medium. That's actually my personal approach. It's a way to uh, kind of give maybe the maximum coverage for minimal cost. Where you're kind of weighting heavier the term ratio of that blend. Um, and why that's important for maybe the new people to understand is permanent insurance, as you've kind of understood here, it costs more. And so, for every $1,000 of permanent insurance with our carriers, there's an embedded cost that is assessed. And so, to really build these plans out for optimization, we want to be building them in terms of a minimal death benefit, maximum funding scenario. This is where I have seen the policies that I have on the books to be the most, effective, optimal for the client. And that's just by way of, mathematics. If we can get somebody the minimum amount of permanent insurance and them funding it in a very healthy manner it does them way better too. So, contrary to the industry, if you're get on enough, YouTube channels and some of these, naysayers on permanent insurance, you hear the commission hungry agents that are selling these, large policies because they pay a healthy commission, the bigger that target premium is, and that target premium is connected to the amount of death benefit that the agent is selecting. So to really distinguish ourselves and rightfully portray us as the fiduciary advisors that we are or we're pursuing to be, this blended approach that Alec is speaking about has so much merit because it positions us as an advisor that's looking out for the best interests of our clients, and it's going to be in the client's best interest too because they're getting an optimized plan too. So yeah, that I think that blended approach can be a great kind of middle point when you're sitting down with your client and kind of seeing where they're at with all this.
Yeah. So I think the last thing I would want to cover on my end is who are maybe some good candidates for this. We'll talk about companies and all that. We'll walk through some illustrations here of high level how it works. But I think there's a couple people that it's a really good fit for that will naturally gravitate towards this conversation when we talk to these types of people. So the first is people that have some type of a defined benefit plan or AKA a pension. So, Tony, obviously, we've had some cases. Becky, you and Zach, that was what we had done was we did permanent life insurance on Zach. So when we talk to folks that have a pension plan, they have a monthly payout. We walk through all of those things, and the way to kind of solve the question of do we take a single life, do we take survivorship, all those things. Permanent life insurance is a mechanism to be able to solve that problem. And to kind of combat that easily, we could say, well, let's just buy term and invest the difference. Well, Tony, does that always work out? Do we always do that every single month? No, not necessarily. So I actually did a case at the end of last year into the beginning of this year. Same thing came up. It's a guy retired from the military, has a pension, and they said, well, we did research. We can get a bunch of life insurance for cheap, buying term, and we'll just invest the difference. Well, I said, okay, well, that works until it doesn't work. What happens when this comes up or that comes up, or you stop contributing to the investing the difference portion, and then all of a sudden we don't have 500 grand in 20 years saved up. Oh, and by the way, that is not for buying a new house or taking a vacation. That is just to protect the death of the pensionee. And that's a really awkward conversation. And I think you can gravitate towards, hey, you know what? We probably need to have a permanent policy on the books there. So that's a great example. Now, we're not going to get into too specifics, but I just wanted to kind of bring that up. Another example is like I had mentioned at the beginning of the call here, someone that just flat out says, I want permanent life insurance. I have multiple people that have approached me saying, hey, I want to have a permanent life insurance policy on the books because of my parents have one, or I've heard good things about it, or I understand I'm young, but I want to build something, now. Nothing wrong with that. We can go about doing that. And then I think another category of people is maybe they have really high income. So, without getting too deep into the weeds, to contribute to a Roth IRA, the IRS allows for you to put a certain amount of money away per year into a Roth, but they also simultaneously will only let you put that money in if you're under a certain income threshold. Well, I have clients that are over that income threshold, and they now say, well, hey, I've got $7,000 that I want to put somewhere that I can grow tax free. Well, where can I do that? Well, we're limited, and this is an option for us to put money in and grow money long term tax free. But then I would tell you maybe a fourth category here is someone says, hey, you know what? I want to build a bucket of money that I can maybe loan from, take distributions from, have the ability to access at certain points in time. But I don't want it tied to retirement. I don't want to wait that long. I want some flexibility. I want kind of immediate access to it. This can be a mechanism for that. It doesn't mean it's always the case, but I'd say those are kind of 4 or 5 broad examples of maybe types of people that we'll come across that in a good cash flow situation, a healthy environment, we can talk to those folks and demonstrate why a permanent life insurance policy could solve some of their problems or implement some solutions to help get them to where they want to go quicker. So that was kind of the last thing that I wanted to talk on. When we get together, I can share my screen. We'll go through some examples, but I think if we went about that route today, all of a sudden it'd be another 45 minutes. So I don't want to get too deep in the weeds. Um,
Just super quick, I threw a video in the chat for those that might be on their phones. I'm not sure if it registered, but it's a Dave Ramsey video that actually really is articulated well. What's that?
did you guys hear that video start playing?
Oh, you started playing it?
Yeah, I like clicked on it and it like was super loud. It wouldn't let me pause the video.
Yeah, watch the video on your own time, Alec. But no, in all seriousness, it articulates what Alec talked about in the beginning, which is the predecessor to IUL and VUL was whole life, and that kind of dominated the industry for a couple decades. And I think it's good to start to understand why clients have a negative view of permanent insurance, and it's largely attributed to this product. And Dave articulates really well kind of what it is and why it's poorly portrayed by a lot of agents. And it feeds right into kind of the appropriateness of what we predominantly recommend, which is on the universal side. So I think it's really important for any of the recommendations we make for them to be understood by some clients. And I've even, sent some of this to some prospects, like for them to understand what I'm recommending, you got to understand where we're coming from and what this is being compared to. So anyways, just good resource there for you guys to watch on your own.
I like it. So if we were to stop here, anybody have any questions, thoughts, comments about anything we've talked about here today? Going once, going twice. No. All right. Well, yeah, we'll get together next week and we'll cover what does this look like, how does it grow. We'll walk through how an illustration is designed. This is not meant to be overly complicated, but explaining a lot of things takes time. So that's why, for those of you that are new, working together with someone that has experience is super helpful. The first, number of times that I saw this be put into practice, I was like, there's no way I'm going to remember all of this information and be able to deliver this. Holy crap, this is crazy. Doesn't have to be that. So it's very simple. It's just a lot of bases to cover, just like anything else we do. So yeah, we'll get together next week. We'll answer some more questions and make this look a lot cleaner. So you guys have a good week and we'll talk here soon.